Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to us today, as well as every week. We're on the show. We're on different stations, different cities, Albuquerque up to New Mexico, up to Las Vegas, Nevada. We're up in Central California, up in the Tahoe area at K Tahoe, and certainly in the Inland Empire in Southern California. At a couple of stations in San Bernardino and Riverside, KMET and KCAA. Appreciate those people, fine work they do to bring us to all of you each and every week. We talk mortgages, we talk real estate, we talk what's happening now, what's probably going to happen in the future. We were wrong last year, absolutely wrong. This year we seem to be okay. We're batting a much better percentage. Why? Because it's easily predictable. Once you're at a certain level, it has to go a certain way, right? We know rates have to come back, have to go up, and they have been. We know that the yields on the bonds have to start going up just because that's the way it is. Now, the reasons for the bonds and the reasons for the real estate mortgage rates going up, yeah, they're varied, but predictable. The one thing that we can't predict is whether we have a housing bubble happening or whether this is just a natural course of a very bizarre set of circumstances, starting with COVID-19 last year. And a lot of the housing that was going to be built or is being built isn't built fast enough because we had what we called, and last week, I understand Daryl, you and I figured it out, right? The K-shaped recovery. What is that again?
It's multiple factions making recovery at different times under the same circumstances.
Right. Okay. So we have 11 million people still out of work. We had about 20, 25, let's say. It depends on who you talk to. Million people out of work at the start of the pandemic when we saw everybody get laid off in the industries that had to do with restaurants or any service-related industries. Certainly a lot of retails got closed, any sports arenas, any large gatherings, all that stuff got shut down, and many, many millions of people went out of work. Well, now we have less than half of that still out of work. What's going to happen to those people? So that's the group of people that are not recovering at all, right? And in that group is everybody who's in forbearance. And there's roughly 5.5 million houses that have a mortgage that aren't paying their mortgage. And there's 2 million of those that really aren't paying a mortgage over the last 90 days. So those people are in trouble. Now let's talk about renters, people who are in the rental world. And there are many of them, and there are many reasons people rent. But let's just say, for the lack of a better way to say it, that people who rent are people who can't afford a mortgage. People who can't afford a mortgage, who want a mortgage because they realize, like I do, like everybody does, that if you get a mortgage, you get a house. And if you get a house and you pay it off for 30 years, you own that house. And that's a way by which you can build your own wealth, your nest egg. And the way prices have been going up last year and predicted this year, 10% last year, almost 10% this year. That'd be a 20% gain in 2 years. So if you bought in 2019 at a $500,000 house, in 2 years, it'd be worth $600,000. Now that's a heck of appreciation. Let's say you put 20% down originally. Now you have how much equity? That's how you build wealth in America. But for those people in the bottom half of that K-shaped recovery, you're not getting out. You're not going anywhere. The reason is that the job you had isn't around. Now, we have a lot of things going on in Washington right now. The main thing is trying to decide whether we are coming out of the recession and that things are getting better, or that we're not going to come out of the recession for 10 to 12 million people. Those people are done, gone. What's going to happen to them? So this K-shaped recovery and what we're talking about in terms of housing and mortgages. So as housing prices rise, as renters who are in this forbearance or moratorium get closer and closer to the June 30th, mid-July deadline, when moratoriums will end, because what we'll have is a double whammy, right? We'll have an economy which is gaining steam. There's no question that it's doing that now and has been for the last quarter, maybe quarter and a half. when we saw half of those jobs lost come back, when we saw the economy doing well because of the stimulus package originally given. We're going to get another stimulus package, right? Whether it's the $15 an hour one or whether it's sans that, without that. We're going to get this money. Let's say it's a 1.75 trillion. Let's say they shave it down a bit. Big numbers, and that's going to be long lasting and effective at jumpstarting an economy. I read an economist today that said 6% GDP this year. Now that's a big jump from last year when we were negative, right? Now Q4 we did okay, Q3, but we were down 33% in Q2 or Q1. I mean, that's a significant, difference between where we were and where we are today. So we're adding this stuff up, right? We've got the economy coming back because of the stimulus package. The economy coming back because more people are back to work and wanting to spend money. Now, as we've talked on the show, the savings rate in the country during COVID, 33%. So if you were out there and you had a job, you're saving 33% of your income because you just didn't know if you were going to lose a job. And that goes true for straight across the economy. And that's a big number. That's $1 trillion. I think $1.5 trillion, they said, in savings. So we've got huge pent-up savings. We have an economy roaring back. We have jobs coming back because the economy is doing well, and we have the stimulus package. All of this means that this year, 2021, is going to be a great year for the economy. But what does it mean for people who want to get into the housing market? Well, it's not a good thing because, as I said, we have rising prices that aren't going to quit anytime this year. What does this mean for rising mortgage interest rates? Well, it's based on the bond market, but it's also based on a lot of ifs, ands, or buts, meaning that I'm not quite sure, other than banks want to take a bigger profit. I mean, that's what I'm absolutely sure of. Lenders want to take a bigger profit. Fannie and Freddie, by the way, I don't know if Daryl, did you see this? Freddie Mac made $8.2 billion last year. This is the company that buys loans from lenders. $8.2 billion, Freddie Mac. Freddie Mac and Fannie Mae make up the government-sponsored entities, which are still in conservatorship by FHFA and Mark Calabria.
Yeah, no matter what it says on your loan documents, those are where they're probably at.
Yeah, exactly. It's funny. You say loan docs, and it only makes me think they just changed the loan application. And by the way, we're at Malibu Funding, the company I work for, is trying to put together a bunch of videos. Now, I went to several online and liked a lot of them too. I'll just name a couple: Mortgage 101, Homebuyer Mistakes to Avoid, 2021 FHA Loan Requirements. All of these are shows that you can see, and the people running them, talking about them. Great information. But we're in the process of doing this in multiple languages to try to help people. There's a new loan application just got launched yesterday. So all of this, are things that we're trying to do in order to help the market. But if you don't have a job, if you cannot get into this housing market, and you're facing a moratorium on your renter not being able to pay because you lost your job at no fault of your own, there's a problem. So 11 million people, what is going to happen to these people? Now, I know we micro-focus on the worst, and that's true. There are still 142 million people working. At the height, when we talked about less than 3% or close to 3% unemployment, which is historically full employment in the US, that's kind of how we look at it. That was only 152 million people. So the 10 million people between 42 and 52, 152 million, are the 10 million people that are still out of work. But yes, we focus on those people because of the suffering. And we seem to look down party lines as to who exactly can we blame for this. Well, what can we do about it? And how do we get these people invested in America? And in America, it means how can you get them a home that they can pay a mortgage on, that they can afford? And all of this has to do with getting people back to work. So the best thing to do really in any market is to continue to spend money so that people will have a job. And that cuts across all lines, whether you're conservative or whether you're not conservative, whether you're liberal, whether you're not liberal. Having people work is the best way to, get the country going and get people invested in what we're trying to do, which is, sell the American dream, get them into a house, build long-term wealth. Thanks for listening. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening each and every week. Appreciate it very much. We get a lot of great feedback. Matter of fact, I had a call the other day from a customer who heard one of our guests on the show, and she was asking about the program and the likelihood that she might be able to get along. Anyway, it was good, because positive feedback, negative feedback, any feedback is always good. If you do hear the show, and you hear it in a place where you can click on that you like it, or you want to give us some feedback, that'd be great. Certainly, if you go to YouTube, that's where you can see the show. We also shoot this for video. Jeff Barton, the Mortgage Voice, that's the show. Go there, click on that you like it, join as a member, all of that. All that good stuff helps us get the message to more people, and that's really the purpose of the show. And you always do help me do that by just listening, one, and saying that you like it too. With us today from Next Us is Brian Hewitt, who's been on the show several times before, and I'm glad to have him back again to talk to us about some programs, what's going on at Next Us. Brian, how are you?
I'm doing very well, and I'm glad to be back with you. I hope everything's going well.
It is and it isn't. We talked earlier in a segment on the show just about how some people are hurting badly, haven't got their job back. Their renter moratorium is about to end in June. They don't know what to do. But on the other hand, a lot of people are doing really well and, want to buy a house. So, yeah, that's kind of how we're doing.
Yeah. Well, it is interesting that while people aren't necessarily having to pay their rent or their mortgage right now, a lot of lenders are okay with the forbearance issues as long as they can bring those current on the subject property that they're financing. They don't consider it a negative. So,
okay. Well, that's good news.
People are going to have to be careful what they're being sold out there, because there are going to be lenders that are going to come out with product that may not necessarily be to their advantage.
Okay, good point. Protections against that sort of, I guess, predatory lending. What are you doing over where you are?
Well, what we do is we really look at the situation that the borrower is in. If the borrower has the ability to get themselves back right, and then we can put them in a lower payment, or if to get them back right, they need to extend their term to do that, whatever it takes to actually get them to where they're truly in a better position. You never want to pay somebody to put you in a better position. So if somebody says, "Oh, I can do that for you, but it costs $2,500 up front," hang the phone up.
Yep. Yeah, no, that sounds a lot like those loan mod scams back 10, 12 years ago.
Yeah,
Right.
I wouldn't be surprised if you see something like that again in the near future.
Well, yes.
There's a lot of people that have, $4,000 and $5,000 house payments that they haven't made payments in almost a year.
Right. And I don't know how that is going to affect the industry or each individual lender, but certainly borrowers who get notices that the forbearance is about to end are going to get real scared real fast.
Well, I will say this as a lender. Communicate with your lender. Talking to your lender is the best thing that you can do. If you shut down and don't answer their phone calls, that only hurts you. The lenders are willing to work with borrowers, but you have to talk to them.
I liked your idea of multiple ways by which you might be able to get help from your lender, either an extension or of the loan itself, maybe a redo in the terms, maybe adding years onto the end. All of these things are designed to try to keep people in their home, which is what I'm really hoping happens more than not.
I truly think you're going to see a lot of that. I mean, you're going to see more creative products come out. You know, like a lot of people don't make more money on bank statements than they might do on tax returns. So you'll see more of that.
Mm-hmm.
But your lender that you have your mortgage with now can also help you. So that the importance of communicating with them, I can't stress that enough.
Let's talk about the borrower who is who's flush, who's making a killing here during COVID. And believe it or not, we in the mortgage industry are among those kind of people. What do you say? What are some of the products that you have available to get somebody into a house that may not have had that ability a year ago, but now is making pretty good money? And, you know, the rates are still pretty good. What are some of the popular programs over there?
So the interesting thing is our underwriting philosophy is different than a lot of companies. We have what we call cascading underwrite.
Okay.
So we start with the most information, and if that doesn't work, we'll slide the rule down a little bit, maybe go to a different program. So we offer full doc bank statements. We offer bank statement and asset combined to make it. What we're looking at is the ability to repay the loan.
Of course.
Look at those. We have P&L programs. For rental properties, we do the DSCR, which is where if the rent covers the mortgage, that's the end of it. And we're seeing a lot of borrowers who are pulling equity out to buy additional properties because the money is fairly cheap and the equity growth, especially in California, is high.
Very high. I just, on an earlier segment, was talking about year over year. I think the property values went up 10%, and they're predicting another 9% this year, which is unbelievable considering before COVID, we were looking at really a market de-escalation in pricing and more people being able to get into the market. A lack of housing is a problem. Obviously, rates being low is a good thing. So solving the problem of how to get more people into homes, do you see any down payment assistance or any kind of a FHA resurgence, or do you see more other kinds of creative financing?
So FHA. The lower you have, the least amount of money down is going to become more expensive to do. I don't anticipate now any time in the near future being cheaper than buying now, because you have escalating rates and you have escalating values, and those two things combined, as a lender, that's when we want the borrower to have a little more skin in the game. So you may see 95s drop to 90s, but we're also talking about over a year or a year and a half from now.
Right. So your attention to doing it now rather than waiting and costing you more or pricing you out of the market is probably good advice.
Oh yeah, I mean, right now, if you have the ability to do something now, I would do it now because rates will climb. I'm not saying they're going to climb and skyrocket to 7%, but even if they climb 0.5% and the value of a house goes up 10%, that's a pretty significant difference.
Oh yeah. When you're dealing with median prices of well over $500,000 in a lot of the country, I mean that's significant money.
I read an article this morning. Just in Orange County alone, we had 5 more zip codes this last month where the median price went over $1 million.
Yeah,
in our county, we have 53 zip codes where it's higher than $1 million now.
That's not significant. That's ridiculous. I mean, and how can a person who is like lost their job and certainly rent is, if you're renting, is going up as well. There's a disconnect here. I'm not sure where it ends out, but certainly getting into the market now, building long-term wealth. What do you do for the first-time home buyer? It may be other companies. Well, maybe they do it too, but how do you handle first-time home buyers? What can you do for them?
Well, so for a first-time home buyer, the important part is that you actually work with a broker. You know, my company may not be the best company, or the company that's on the second floor of my building may not be the best company for a first-time home buyer. But by working with a broker, they have 100 different lenders to go to. So they have the ability to put somebody in the best fit. I'm a firm believer that I don't, when I buy a car, I usually go to a car broker. I don't go to the dealership myself, just because
Right.
I'm for a specific thing, and I would want it. And sometimes I buy a car, it doesn't even come from where I live; it comes from somewhere else.
Right.
I think dealing with a broker to buy a house is probably even more important.
No, I like the attitude. It's mine exactly. If I can't do it, I'll find somebody that can do it and probably do it cheaper. And I think in certain circumstances, that's best for the borrower, which is ultimately is best for the market.
Yeah, you don't necessarily always go with who the real estate agent says you have to use.
Right.
And don't always go with what you read online. You talk to somebody on the phone and really get an understanding of what you're getting yourself into as a first-time home buyer. I mean, it's a great experience, but you also need your hand held a little bit through the experience, because you could accidentally give something not knowing that it's a negative because you thought it was a positive because you're not in the industry.
Hey, Brian, we've come to the end of it. I'm sorry. This has been a good discussion. I really appreciate you doing this. If you don't mind, you could shout out your phone number or email address or some way which people can get a hold of you directly, because you have so many good things to say, and I need them to get in touch with you.
But I'll give you my phone number. It's Brian Hewitt, Hewitt, and my phone number is 949-529-7366. If you do call, I have quite a few. I'm on the phone most of my day. If you leave a message, I will call you back.
Brian Hewitt from Next House, thank you very much once again for coming on the show. Really appreciate it.
Thank you, Jeff.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. We bring to the show many different people from all over. We've been doing this show 7 to 8 years, and we've talked to thousands and thousands of people, whether it's local, whether it's national, whether it's a lender, title, escrow. We talk to mortgage agents, brokers, and the best way to do real estate, as I said in the earlier segment, is to try to do it locally. Like politics, everything is local. So if you're in a market right now that is experiencing a certain type of purchase or disruption, it may not be that way in other markets. So perspective is the way you get the best education in our business, and today is no exception. We bring to the show, first time on the show, and I really appreciate it, Eddie Rael from down in New Mexico way. I believe it's in Albuquerque. Is that correct, Eddie?
Yes, sir. I'm in Albuquerque, New Mexico. Yes, sir.
Excellent. Thank you very much. Well, thanks for coming on the show. Appreciate it.
Well, now, thank you for inviting me. I'm with Realty One. It's the largest brokerage in New Mexico right now, and the fastest growing. It's really, really a good place to be.
Yeah, we have a lot of Realty One people. I do business in 13 different places, 13 different states. In Nevada, I see that Realty One quite a bit, and also in Southern California, where I happen to live. How is your business down there? Interesting time in the business, isn't it?
It's quite good. The only problem we have is inventory is so short that we're having a hard time finding homes for buyers. We got a lot of buyers lined up and not enough inventory for them at this particular time. And it's been that way for almost a year now.
You know, it's interesting you say that. Okay, let's talk. How are we addressing the problem there? Are the big builders still there? Or is it still infill, smaller deals?
Oh, okay. But what has happened is the rates are so low right now and stuff. Everybody's trying to buy, and a lot of first-time home buyers are trying to buy. But they're driving the prices up. And when a house goes on the market, especially like in the 150 to 250 range, which is pretty much standard for Albuquerque, you get multiple offers on the house. And if you don't bump it above the asking price, you're not going to have a chance of getting it.
Tell me how you give your clients advantage when they're in multiple offer situations.
Well, what you can do, there's a few things you can do. You really can't change things too much, but you can make sure that your buyer is completely qualified or pre-qualified to the extent, instead of just saying, well, I have a good job and this and that. I have a letter from a reputable mortgage company. He is qualified. He's brought his documents in, and he can buy up to this particular price range. So you want to make sure that the seller knows that the buyer is not going to be that's going to be able to close the deal. That's part of it. Another thing you can do is tell them, okay, we're going to buy your place. I'm going to make my earnest deposit non-refundable. Take my offer, and no matter what happens, I'm not going to ask for my earnest deposit back if anything changes. And the other thing is, don't ask for too many items when you're buying the property. Right. You always want to get inspections and stuff. Make sure that the home is what it's supposed to be. But you don't want to ask them for so many things that they're going to look at somebody else's offer.
Do you feel a little bit nervous when you're offering up the deposit from the borrower? I don't know in your area, but where I've done business, I always take a personal responsibility, and a lot of times have to end up, if the deal doesn't go through and they've given up their deposit, to reimburse the borrower. How does it work there?
Okay, well, if you're going to buy the property, we're going to buy the property. That's all there is to it. So I want to make sure that that seller knows I have a well-qualified buyer. He's putting up a good-sized earnest deposit, and if he changes his mind or backs out of the deal, he's not going to ask you for his money back, as opposed to the other guy that's not offering you that. Take my offer over his offer. That makes your offer stronger than somebody else's offer, and if you're not willing to do that, then maybe you don't really want the house. But, right now it's a seller's market. You got to do whatever you can to convince that seller that you're the buyer for his home.
The confidence by which you tell me that, I'm thinking, okay, if I was a borrower or a buyer, I would go, yeah, of course, that makes 100% sense. You've been in the business a long time. Have you seen a market like this before?
It's been quite a long time. I've been doing this since 1980, 79. It's been a little over 40 years. I was just a kid when I got into it. And I've seen the market go in and out and up and down. But I've never seen this much of a seller's market. If we've had seller's markets before, 05, 06, 07, the market was just going crazy, and everything was selling like crazy, and prices were going up. And then the bubble burst, and in 08, 09, 10, prices started coming back down, and we ended up where we're at a few years ago, stabilized. But now, again, it's a seller's market, but that doesn't happen all the time, and I've never seen it to this extent. Never been this much of a bidding war on almost everything that comes on the market.
Now, you have pretty steady employment there with government contractors. The government's very heavy in terms of the employment base there. Do you see a point where the price appreciation diminishes because you have really set employment and the chance for making more money is limited? Or do you see the fact that there's new industries, new businesses coming to town, which is really helping push the price?
Well, I think that they're kind of artificially high right now because for the average income of the median income in New Mexico is not like it would be in California or in Arizona or in Colorado or some other places. So people are having to pay a lot of money to get into a home because the rents are also high. So eventually it's going to have to correct itself, just like the stock market does. A year or 2 years down the road, rates go up a little bit, and people are not getting enough of a difference in raises to be commensurate with the raise in price of the homes. So they're going to have to stabilize sometime down the road. So I would think that they might not necessarily drop, but we're not going to see increases like this in the near future anytime soon.
What has the increase been? I know nationally we're looking at close to 10%, but what are they locally in Albuquerque?
Oh, it's been at least 10%. I mean,
see.
The properties have really gone up quite a bit just in the last year or two, and it's the income here does not support that. So eventually we're going to have a correction or an adjustment.
Do you see a lot of these not foreclosure, forbearance properties in your area? And do you think that the lenders will work out a long-term solution for people who are just now getting back to work, who've maybe missed several payments on their mortgage? Or do you think those will be going to foreclosure?
Think about it. It's not to their advantage to take a property back from a person.
No, it's true.
They're going to put it on the market. They might get less than what the guy owes on the property because that's just the way that's the nature of the beast. So they'd rather not repossess a property as long as the guy is trying to come back and make some payments. You know, they may not make it up right away, but they're better off instead of trying to repossess a house and reselling it. He's going to sell it at a greater loss than if he stayed with that same person and left him in the house and gave him a chance to take care of that forbearance.
How do you check comparable prices in your area? Do you do it through the multiple listing?
Yeah, we do. We use the multiple listing quite a bit, and in some areas there's a lot of sales, and it's real easy to get real close to what things are actually selling for. But then we do have a lot of rural areas also,
right,
where there's not that many sales, and then we have to go by the principle of what will the market bear. You know, if you're putting it on the market at X amount and you're not getting any activity, you know you're a little high. Also, we have realtor tours, and we have a lot of different ways to get feedback. And if we get feedback that we're a little too high, then we need to adjust downward, you know. If we put it on the market and we're getting a whole lot of activity on it, then we hold tight where we're at, or maybe even bump it.
Eddie, we're at the end of our interview. Can you shout out your name, telephone number, place where people can get a hold of you there so that you can spread the word about what you're doing?
Sure, I do appreciate it. Anything in the metro,
Sure.
New Mexico, Albuquerque, in the general area. My name is Eddie Rael, R-A-E-L. I'm with Realty One of New Mexico. My phone number is 505-550-7235. 505-550-7235. My email address is fast505eddie@aol.com. fast505eddie@aol.com. And if you can remember this, eddierail.realty, all my information is on my webpage, eddierail.realty. And I'll be glad to help anybody that might want to call, get information about New Mexico. If you're thinking of moving here, appreciate it if you give me a call.
Eddie, thank you very much for coming on the show. I love your email address. I really do. I think it's great. But I appreciate you doing the show, and we'll have you back again.
Well, thank you very much for allowing me to be on your show.
Sure.
And thank you again, okay?
You're quite welcome. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week to the show. We are on 8 different podcasts. That's right, the big 8, they call them, plus a couple more coming. Daryl, you got that list for us, please?
I do, sir. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and soon to be on Podclips.io.
Okay, Podclips.io, new to come, great source of information, especially in the financial area. And if you want to see this show as well as our daily, which we do on Facebook and LinkedIn, go to YouTube, Jeff Barton, the Mortgage Voice. That's my YouTube channel. And you can see it, hear it, and you can like it. And I'd like you to do that. If you could like, that'd be awesome, because more people will see what we're trying to do. And we've got a lot of exciting plans coming for the show. Today, back to us is from up in the central area of California. We've got a great guest once again, Darren Woodworth, who's going to talk to us a little bit about real estate and mortgages. Darren, how are you?
Oh, great. Better than I deserve.
Don't say that. It always kills me when you do, because it gets me laughing, and maybe that's the best part of talking to you. I get a nice smile on my face. Thanks for doing this. And what's that? Go ahead. What?
Blessed and highly favored.
Excellent. Okay, tell us about the market. What's happening? Where are you? And where do you see it going to?
I'm actually up in Napa, California, Vallejo area.
Yep.
It's on fire still. It's multiple offers on properties, more buyers than sellers. So we're getting a lot of overpriced, marked up homes. So it's slowly getting. Vallejo used to be the only affordable city on the bay, and it's slowly going away.
Now, when you talk affordability, give us a price range.
So 400.
Right.
Get a house in Vallejo at 350. They were 250 not too long ago. Now they're 350. Anywhere up to 2 million.
How do you get your borrowers into those kind of properties with multiple offers?
Very strategically.
Okay. What's your strategy?
Property with a sold sign, and make sure you talk to the realtor right before you submit your offers. Ask them what they're looking for. Get a feel for, I kind of go by the property and see how many people are visiting it whenever it's an open house or when it's open, and see what the market is. Last weekend I was at a property and it was slammed all day long. So people coming and going.
Yeah, in a situation like that, they're not looky-loos. They're looking for a place to live if it's that busy.
Absolutely.
Yeah. Yeah, okay.
And
So
if you ask your realtor, what do you think we should offer for this property? And your realtor says $525 and the property's listed at $489. And you offer at $500 and you don't get the property, and you could have got the property, if you kind of missed out on the deal this weekend. So kind of a little frustrated.
I see. It's for some reason, some buyers are like that. They need a chance to negotiate for whatever reason, even if they can afford the price that'll get them the property. To understand that, what, in order to get this property, you got to offer this right now. It's just not in their DNA to be able to say, okay, I'll do that. They want to be able to, they'll get there if they can negotiate, but they won't do it off the bat. And I think that's what you're referring to.
Yeah, we'll probably be in the market for another 2 or 3 or 4 months, maybe 6 months doing the same thing. So
right.
Sometimes you get those buyers that are like that. So just got to roll with it.
Yeah, I know. I do know that. And I know, given the fact that we're a service business, you can't really make anybody do it. You try to give the best advice possible, but ultimately the client is the boss. And that's the discouraging point, because they could get the house. They know that they can afford it, but not being able to step up when they're required to is an issue that, obviously is very frustrating to you, but them as well. They're not getting the property and they're not understanding it.
Yeah, absolutely. It's $100 difference between
right, payment wise, right. No, and that's, I think when you reduce it to something like that, and people have sticker shock for some reason, they still do, even in a market that, California went up 10% last year. I mean, you have a property of 500,000. Well, it's 550 today, and next year it's going to be worth 600,000. And that's no lie. And 500,000 is, not even close to what a lot of these properties are going for. I mean, you're talking $1 million properties in some respects.
Yeah, this property, you actually sit in the front part on the bench before you enter the house, and you look over and you see the 2 tops of the Golden Gate Bridge from your front yard.
Okay, so you're paying for that.
Yeah.
Come on, that sounds like it's a very, very, I guess, worthwhile property to obtain, especially in a market where. Now, you tell me if this is true in this kind of market. Do you see trophy buying whereby a customer would want to get into something because the market has changed so much? Different buyers are changing the nature of the neighborhoods, so it becomes more like keeping up with the Joneses? Or is it still about what you can afford wherever you can afford it?
It's about affordability right now. This client, he's the one that got me into real estate and loans 20 years ago.
I see.
He drove up 2.5 hours from South San Jose, Morgan Hill, to see it. And he knew better, and he called me up and said, man, I should have listened to you. The property was for $5,000, his mortgage was going to be $2,000 a month. Could have rented the bottom unit for $2,500 and lived in the top unit and had a free rent. So he knows he kind of dropped the ball.
And for what, $5,000?
Yeah, for the rent, they were renting the bottom unit. It's 2-bedroom, 1 bath in the bottom, and 2-bedroom, 1 unit on the top. It was a house, but they had a door where you just shut the door, and it blocks
Right.
off upstairs and downstairs. So could have rented the bottom unit for $25 and lived in the top for free.
Yeah, it happens that way. And I don't know, I mean, are you finding more qualified buyers or less qualified buyers than you did, let's say, a year ago?
It's hit and miss. I probably lost maybe four buyers because of income, because of unemployment and
Right.
out of work. So it's I just picked up another one. They just moved from Napa to Nevada, Carson City,
Yep.
a year and a half ago, and now they're coming back. So I'm looking for them for something in Vacaville. So they tried the Nevada experience for about a year and a half, and they've had enough, and they're coming back. So.
Well, Carson City's a different kind of Nevada. I mean, there is old Nevada. There's, obviously gambling Nevada. There's, wide open space. You're on your own Nevada. It just depends on if, whatever you're used to and liking. But certainly it's nothing like where you are. I mean, it's like a completely different place. It's like day and night almost.
Yep. Yeah, I'm 2 hours from the snow and
Right.
Half an hour, 45 minutes from the beach. So.
I know. That's the beautiful thing about living in some parts of California is you can get to places to recreate that are just spectacular, and it's a short drive away.
Yep.
Hey, listen, Darren, could you shout out your phone number for people in case they need a great realtor and loan officer up in your area?
Absolutely. My number is
Right.
408-425-7845.
Excellent. Okay, so one last question before you go. The market, where do you think we're heading, and how soon do we going to get there?
That's a great question. Well, I got a property coming up this month, at the end of the month in Napa. It's a 3-2. It'll be selling for $775. It's on a 10,000 square foot lot. It's got a house in front, and you could build another house in the back, so it's like a duplex lot.
Yeah, that's nice.
Multiple offers on that. It's up in Alta Heights, Napa. So I don't see anything changing. I mean, like COVID came along, I'm like, oh, it's going to crash. No,
Yeah, me too.
No, it didn't. It kept going. So
No, it got worse. It got harder to buy. It wasn't easy. Listen, Dan, hey, man, I got to go. We're at the end of the clock. I really appreciate you coming on, giving us your perspective and what's happening up in Napa. Appreciate it. Thanks.
Thanks, Jeff.
Okay, thank you. That's Darren Woodworth. He's from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hi, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening. This is Jeff Barton, the Mortgage Voice, and you can see us YouTube. If you go to see the show on YouTube, go to Jeff Barton, the Mortgage Voice. This, as well as our daily 5-minute LinkedIn and Facebook show. We're trying to roll some other videos in there, educational videos about how to get a mortgage. What does it mean to do this? The 5 reasons that seeking professional help is better and cheaper in the long run than doing it on your own. Things that really can be nuts and bolts in the industry. We're all also on 8 different podcasts, the Big 8 podcast, plus a couple of new ones coming up. Daryl, you got that list for us?
I do. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and PodClips.io.
Excellent. PodClips.io coming soon. Do you know when that's up, Daryl?
Next week.
Okay, excellent. Very good. So we'll have a little launch party, and that's pretty exciting. There's a lot of good information there, especially in the financial area. A lot of it's podcasting, good information, good people who are doing the shows. So I recommend going there as early as next week. So thanks very much. We're also on 5 radio stations, 3 different states. Or is it? Yeah, that's what it is. We're in California. We're in New Mexico, and we're in Nevada. Yes, all these places are where we are. Sometimes they get confused. Reason is because we talk a lot on the radio about all different numbers and figures and what's going on. So the confusion about where we are and what we're doing, we're always constantly also looking for additional stations. So a couple things. One, if you go to a station and listen to us on one of these podcasts, click that you like it, join up, sign up. It always helps us, and it certainly gets you on a list. And then we don't sell the list to anybody. We just want to be able to bring this information to as many people as possible. We bring guests to the show. They're from other companies. We bring account executives from different lenders to talk about products. We bring, from the different markets that we're in. We try to bring local people for the local show. Today, we're going to have, we have had some terrific people on the show from different markets to talk about what's happening down there. Because like politics, real estate is local. If you go to, Iowa, in Des Moines somewhere, or you go to Albuquerque, New Mexico, it's a different market. And the only way to know that market is to talk to people who work in that market. So that's what we try to bring to you. And that's what the show is all about. Let's see. Let's talk a few news items that I think are interesting. Let's see. One of the things that caught my eye, and always does, is when there's some sort of discriminatory behavior, some statistics that come out that say, okay, see, this is why we have to do it differently. Now, one of the things that caught my eye is the story of mortgages, minorities, women, tech, and automation. On women, women and mortgages. It was interesting that they did a study from 2016. Now, a lot of these studies seem to be old and outdated, but it takes them a while to collate the information into a report. And this is what came out just 2 days ago. Single women pay 8 to 10 basis points higher for a loan than single men. Now, is there a reason for that other than they're women and we can charge them more? Well, that's interesting. And I think it also goes back to what we've been saying about how certain things in the tech sector may not be as great for everybody as it is for the lender or for the paper non-minority borrower. What do I mean by that? Well, if you're an underwriter and you've been accused of, discriminatory behavior, i.e. you'll look at one particular borrower a lot differently than another particular borrower, especially when it's the same profile, the same FICO score, the same income, the same, and to note that does happen is a real issue, right? And that's why we have in HMDA, reporting of ethnicities, background of borrowers, certain types of information that the federal government can look at to see if discriminatory behavior and patterns exist in lending. Okay, so that's why those sort of things are done. So this particular study had a couple of reasons. And I think it's because of the way they look at the problem, not necessarily that this is the answer to the problem. The way they look at the problem, this is the credit profile, i.e., what does the person look like on a piece of paper, either in the credit profile itself, i.e. the 3 TransUnion, Experian, and Equifax credit scores, or they look at the risk factors based on, your ability to repay the loan. Both of these things are developed to look at a certain type of borrower. And historically, those looks have been at a traditional type of family where you have people working. Those people working are separated into head of household and non-head of household. That's just the way it looks, especially when you look at primary borrower versus secondary borrower on any loan application. That's how we look at it. So why does a borrower who is female have a different look credit-wise than, say, somebody who isn't? The lack of credit is more than bad credit. So in changing the way we look at credit, no credit is better than bad credit. They don't look at it like that. No credit is no credit. Therefore, your profile is negative. Bad credit can be fixed. Therefore, your profile is more positive. So if many female borrowers have no or little credit, it's worse than having bad credit. Okay? So if you're a borrower out there and you're a guy, you've worked. If you're working, you're more than likely to have debt. Debt is credit. The other thing is, some people pay their bills better than others. And I would say that there is a group of people who do that. Those people get penalized for paying off debt. And those people tend to be of a certain group. Why exactly is that? That's part of the fixture in the credit, the way they look at credit, the way they look at borrower profiles in credit, that needs to be addressed, which is why when we talked about it last week, how people are looking at credit. What do they look at your credit? Your credit can be a certain thing. Is it a snapshot? Is it a 12-month look at how you've been paying your bills? Is it a more of a different type of credit analysis entirely? For instance, if you go for a commercial loan, they look at that completely differently than they look at a residential mortgage purchase loan. So there's all kinds of different credit scores, credit profiling. The ideology behind that is what is being looked at. It's why we had, who was it? I talked about it 2 weeks ago. Somebody in the federal government was talking about making sure that we change the way we do that particular analysis for borrowers to make it less discriminatory. And that's a problem. So when we're talking about these three things, minorities, women, tech, and automation, all of these things work together versus how somebody who doesn't have to use those particular matrices in order to get a loan. And that is along lines of, if you're a white man versus a person of color, if you are a woman who is also a person of color, why do you have to pay 10%, or not 10%, but 10 basis points? Now you may say 10 basis points. Who cares? What, 10 basis points. Well, a basis point. Okay, 100 basis points is 1%. So really 1/10 of 1%, you pay more. But over a 30-year term loan, that could be tens and thousands of dollars. Why should you pay that much more if, in fact, the real problem here is the discriminatory nature or the way your credit profile is looked at? These are the things that we've been looking to try to address. And hopefully what we'll get is a better system by which we get more fair. Is that even a way to say it? We'll get fairer way to look at things. And to me, that's a better way to do loans. Anyway, I'm Jeff Barton, voice in the mortgage industry. Thanks very much for listening each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.